right, welcome to Iron Financial. This is the show where we forge stronger portfolios by smashing through market weakness. Today, we're going deep on FirstEnergy. They've got this colossal $36 billion capital plan. Now, the big question is this a blueprint for massive shareholder value, or are they just building a house of cards? Let's get into it.
So let's just get right to the heart of it, right? The question we're tackling today is one that honestly should make you pause. Can a utility company, the sector you typically buy for slow, steady, maybe kind of boring dividends, can it actually deliver the kind of high-octane growth you'd normally expect from a tech stock? I mean, think about it. FirstEnergy is throwing $36 billion on the table, betting that they can. They're promising a compounded annual growth rate that's way up there, near 8%. That's aggressive. So you've got this built-in tension right from the start, stability versus aggressive growth. That's the multi-billion-dollar puzzle we're here to solve.
Yeah, a heavy load is an understatement. And look, here at Iron Financial, we don't get impressed by fancy architectural drawings. No way. We're the inspectors. We're the ones who show up, we kick the tires, we take a sledgehammer to the load-bearing walls just to see what happens. We're here to run a full-on stress test on this thing. We need to know if the financial structure they're bragging about is actually built on solid bedrock, or if they're just slapping some fresh paint over some deep, deep cracks. This isn't just about rewiring a grid. It's about whether their entire investment case is going to short-circuit the second it's put under pressure. So, yeah, let's get to work.
Couldn't have said it better myself. Before we can even begin to talk about where FirstEnergy is going with this $36 billion monster of a plan, you absolutely have to understand where they are right now. Their 2025 performance, well, that's the concrete foundation for this entire skyscraper they're trying to build. So let's get into the weeds. Let's forge the financial case and examine the numbers.
All right, first number you need to burn into your brain, $2.55. That's their 2025 core earnings per share. Now, why does this matter so much? Well, this isn't just about making the number. They hit the absolute top end of their guidance. And not just their original guidance, but their revised upward guidance. That tells you something important. That signals a management team that's in control, that underpromises and consistently overdelivers. It's all about discipline.
And that $2.55 in earnings, that represents a 7.6% jump in core EPS from the year before. You got to understand, for a utility, that's powerful stuff. That is not sleepy, slow growth. That is real, tangible momentum. This shows they are already accelerating as they head into this massive new phase of investment. So how are they getting that momentum? Well, they deployed $5.6 billion in capital in 2025. And get this, that's a full 12% more than they even planned to spend at the beginning of the year. Talk is cheap, right? Anyone could announce a big plan. But this is execution. This shows they can actually manage and deploy massive amounts of capital effectively, which is absolutely critical for what they're trying to do next.
Okay, so let's pull it all together and look at the whole dashboard here. You can see it on the screen. Revenue up a whopping 11.8% to over $15 billion. That's serious top-line growth. Now let's drill down to what really matters for us, the earnings. GAAP EPS, the official number with all the accounting rules, that grew a respectable 4.1%. But here's the real story, Core EPS. That's the number that strips out all the one-time noise and shows you the raw operational health of the business. And that, as we just saw, grew by that muscular 7.6%. What you're seeing here isn't a fluke. It's consistent, solid growth across every key metric. This is the bedrock foundation they're presenting to investors, and honestly, it looks pretty solid.
And look, you don't even have to take my word for it. Just listen to the CEO, Brian Tierney, himself. Quote, "We are entering 2026 with strong momentum and a proven business model." He's not hedging, he's not being cautious, he's practically pounding the table with confidence, and based on the numbers we just walked through, he believes he's got the ammunition to back it up. So there you have it. That is the bull case in a nutshell. A company that looks like it's firing on all cylinders, ready to launch into this massive next phase.
Whoa, hold on a minute. Strong momentum? Proven business model? That all sounds great. It's exactly what a CEO is paid to say, but any building looks fantastic on a beautiful sunny day with no wind. Here at Iron Financial, we don't care about the sunny days. We bring the hurricane. It is time to apply some serious pressure to this thing and start actively searching for the structural flaws. Let's see if this proven model can actually handle the weight of $36 billion of pure ambition.
And boom, here it is, the first hairline crack that could spread through the entire foundation. $2.3 billion. That's not revenue, that's not profit, that is the net increase in their long-term debt just for 2026, a single year. So while the analyst is over here talking about all this fantastic earnings growth, I'm asking a much, much simpler question. Where is the money coming from? And the answer, plain and simple, is debt. And let me tell you, debt is like a constant, crushing weight on a structure. The more you pile on, the more stress it puts on every single beam, every single joint, until eventually something gives.
And that really gets to the core of the bear case, doesn't it? Where is the weak point in this grand design? Because trust me, every massive plan has one. Every single one. Is it the financing? Is it the sheer operational challenge of pulling this off? Is it their reliance on politicians and regulators who they ultimately can't control? This is what a real stress test is all about. We're not here to admire the pretty architecture. We are here to find the crack in the concrete, to find that one weld that might not hold under extreme pressure. It's our job to find it before the rest of the market does.
So let's get specific. What are these potential cracks in the foundation? First, you've got massive execution risk. I mean, just think about it. Juggling a $36 billion project across multiple states for 5 years without major delays or cost overruns, that is a monumental task. The complexity is just off the charts. Second, and this is a big one, they are completely at the mercy of regulatory approvals. This isn't like building a new factory where you just need a zoning permit. Every rate hike, every major project has to be approved by a state commission. One no vote from a few politicians could throw a billion-dollar wrench right into the gears. Third, rising financing costs. All that debt we just talked about, it looks manageable today. But what happens if interest rates keep ticking up? That $2.3 billion in new debt suddenly gets a lot more expensive. Fourth, the quiet killer, equity dilution. They say they'll issue minimal new shares, but if cash gets tight, you can bet they'll start printing new stock, and your piece of the pie gets smaller and smaller. And finally, let's not forget the whole reason they're doing this in the first place. Their infrastructure is old. 2/3 of their transmission lines will be at the end of their useful life within 10 years. They have to spend this money. This isn't a choice, it's a necessity, which means they have very, very little financial flexibility.
Okay, those are all completely valid stress points, and any serious investor needs to factor every single one of them into their analysis. But here's the difference. You're looking at the building, and you're worrying about the hurricane. I'm looking at the engineering blueprints. A good engineer doesn't ignore the hurricane, they design a structure specifically to withstand a Category 5. And when you actually dig into FirstEnergy's blueprint for growth, you see that it's been meticulously engineered to mitigate those very risks you just brought up.
Just look at where the money is going. This isn't a random spray and pray approach. It is surgically precise. You see that $19 billion? That's 53% of the entire plan, and it's all flowing into transmission infrastructure. Now, why is that so important? Because transmission projects that are regulated by FERC, the federal agency, historically offer higher and, more importantly, more stable and predictable returns than state-regulated distribution projects. So what are they doing? They are deliberately, strategically overweighting the part of their business that has the cleanest, most predictable regulatory framework. This is a masterclass in allocating capital to the highest quality, lowest risk assets.
And this is the secret weapon in their blueprint. This is the key piece of financial engineering that makes this entire structure work. It's something called formula rate programs. Now, think about how it usually works for a utility. They spend, say, $1 billion building something new. Then, maybe a year later, they have to go beg regulators, hey, can we please start charging customers to pay for that thing we already built? That gap, that's called regulatory lag, and it is a massive risk to the business. What these formula rates do is they completely eliminate that lag. It's like a pre-approved system. It allows them to recover their costs and earn their return almost in real time. It basically turns a risky political negotiation into a simple, predictable, mathematical formula. It is a total game changer.
So you hear that and you think, okay, that sounds great, but how much of their plan actually falls under this special program? That's the multi-billion-dollar question, right? Well, here's the number, 75%. Let me say that again. 3/4 of this entire $36 billion plan is covered by that de-risking mechanism. They've essentially pre-negotiated the returns on $27 billion of investment. This is what gives them such incredible visibility and predictability into their future earnings. It's like having your fire insurance, your flood insurance, and your hurricane insurance all baked directly into the building's blueprints from day one. If you take away one number from our entire analysis today, this is it, 75%.
And that's just the baseline. On top of that incredibly solid de-risked core plan, you've got these massive growth drivers that are almost like free upside. You can see the chart here. There is a 13 gigawatt pipeline of demand just from data centers clamoring for power in their territory. That is an insane amount of new demand. To meet that, they have a $2.5 billion generation project already in the works in West Virginia. And on top of that, they've won $5 billion in competitive transmission projects from PJM, that's the regional grid operator, just since 2022. These aren't just vague hopes. These are tangible, high-growth catalysts that aren't even fully priced into the company's base growth targets. This is the icing on the cake.
So, okay, how does all of this, the capital plan, the formula rates, the data centers, how does it all add up to that 6 to 8% annual growth target they keep talking about? Well, it's not magic. It's a very clear 4-step financial model. You can see it on the screen. Step 1, they use that massive capital plan to grow their rate base. That's the pool of assets they're allowed to earn a return on by a steady 10% a year, every year through 2030. Step 2, they target a very healthy 9.5 to 10% return on equity on that ever-growing base of assets. Step 3, they keep a tight lid on costs, maintaining strict financial discipline on the operations side. And finally, Step 4, and this is absolutely crucial for shareholders, they fund all this growth with very minimal equity dilution, protecting the value of your shares. It's not a guess. It is a clear, logical, and financially sound roadmap to get from here to there.
All right, we've heard the sales pitch. We have seen the analyst's glossy blueprints, and I've done my job. I've pointed out every potential crack in that foundation I could possibly find. So the bull case has been forged. The stress points have been put under the microscope. Now it's time for the final inspection. It's time for the iron financial verdict.
Look, the bull case is built on solid steel. You can't argue with it. 75% of their growth is de-risked through formula rates. That is a fact. They have proven they can execute by outspending their own CapEx plan. They are rewarding shareholders right now with a dividend hike. And the upside from the data center boom is a massive, undeniable catalyst. This is a well-engineered thesis.
Engineered, maybe, but a steel frame is only as strong as the ground it's sitting on, and that ground is getting shaky. That debt load is a huge stress point that you just can't gloss over. The sheer operational complexity of pulling off a $36 billion plan is immense, and things will go wrong. And don't forget, that other 25% of the plan? That's $9 billion that is still subject to the whims of old-school political regulatory battles. Those are not small risks. Those are company-defining risks.
So after weighing all of that, here's the final iron financial verdict. What we have here is a very well-engineered structure, but it is carrying an incredibly heavy load. That de-risked model, the fact that 75% of the plan is under those formula rates, provides a genuinely solid investable foundation. It intelligently addresses the biggest historical risk in this entire sector. But, and this is a huge but, the sheer staggering scale of this plan means that execution is absolutely everything. The blueprints are pristine, they're beautiful, but now comes the really hard part, the years and years of heavy lifting required to actually build this thing. The margin for error here is razor thin.
And so ultimately that leaves you, the investor, with the final critical question. We've shown you the blueprints. We've run the stress test. Now you have to decide, is FirstEnergy building a durable fortress for your portfolio, an asset that can withstand the economic storms and reliably churn out returns for years to come? Or is this a spectacular, glittering skyscraper being built on a shaky foundation of debt, just one tremor in the credit markets away from coming crashing down? We've given you the tools. We've laid out the framework. Now you have to do the work. That's it for us here at Iron Financial.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.